We come now to Chapter 8, Leasing, one of the most feared topics by students, and I can't see any reason why. It's actually extremely straightforward. So, what is leasing about? If you turn, please, to Chapter 8, you'll see there an examination question on the next page. As always, I want to point at the direction of the exam, that big mountain we have to climb. So you'll either get written aspects of leasing, or you'll get a mixture of writing and numbers. Alternatively, you could have exclusively numbers, but be prepared to discuss as well. So come with me to page 117 as we come across a crucial exam point. So where it says crucial exam point, just below that on page 117, I'd like you to do a little diagram with me. About 6 boxes. So allow me to run ahead and set these up. A nice big box to start with. Divided into 6 boxes in this fashion. Roughly similar size. So, you're in the exam. You've picked up this question. Time is ticking away. What is the best pathway I can give you through leasing? The first thing to ask yourself is the question about financial leases or operating leases? So let me put that down. Financial leases or operating leases. Financial leases are more like hire purchase. Operating is more like a rental arrangement. So if I stop for a second and explain the difference, the company needs to have a motor car within its business, either for one of its staff or used as a delivery van. It can either buy the motor car outright for cash, or it can go to a bank and do a deal whereby they pay a little bit of money over several years, and the extra money they pay the bank counts towards interest. So that's a bit like hire purchase. This is what we mean when we say a financial lease. So if you be the lessee, I'll be the lessor. The question is it a finance lease or an operating lease? A finance lease is more like hire purchase. An operating lease is where you rent the asset. So rather than going to a bank, what is an operating lease? This is purely a rental arrangement. You go along to a car hire company, a van hire company, someone like that, and you agree to rent the vehicle for a few years, paying this much per annum. So obviously that's a much easier exercise. Unfortunately, it doesn't come up that often. So is it a finance lease or an operating lease? The next one is the examiner asking us to look at the lessee's books or the lessor's books? So that's the second stage. Let's assume for 1 second it is a finance lease and you have to deal with the lessee's books. The final exercise here, the final 2 boxes I've got to fill, is when the payments are made by you, the lessee, to me, the bank, for example, are the payments in arrears or in advance? In arrears means after the year has passed, on the last day of the year. In advance, obviously, is on the first day of the year. Paying your first installment almost like a deposit before the contract begins. So let's say on the left-hand side, in arrears. On the right-hand side, in advance. Now, let's make a judgment here. What is most likely to come up? probably a financial lease, because that is 5 times more difficult than an operating lease. Lessee's books, most likely, rather than the books of a bank. And which of these two? In arrears, sometimes; in advance, at other times. So I'm afraid both are important. In arrears, about a 48% chance; in advance, about a 52% chance. The reason why I go for a slight bias towards in advance is that students don't like the in advance complications. And the examiners picked this up, and he recently has begun to go for that in a bigger way, examine that more frequently. So let's do both. What do you say? Let's do both. So, the financial lease, lessee's books, is it in arrears? Is it in advance? That's the most likely pathway through the diagram that the exam question will take. Now there follows, lower down page 117, the financial versus operating lease. Near financial, if you put in the word hire purchase. Near operating, if you put in the words rental charge. Obviously the rental charge goes to the income statement. As you can see there, it transfers all the risks and rewards of ownership from lessor to lessee. On the next page, page 118, right on top, on the left-hand side, if you'd introduce the word financial, on the right-hand side, introduce the word operating, please. There are risks and rewards. Basically, if you're the lessee and I'm the legal owner, the bank, I've given you a check to pay to the supplier of the motor car, but the amount that I've given you, you've got to return to me plus interest. So clearly that is the complication. You've got to isolate the interest and how much is shown in the income statement and the statement of financial position. It's lovely stuff, and if you can somehow handle this, you'll stand above the crowd in the exam. Comes up as standards questions, comes up as part of published accounts, could be anywhere in the exam. About the only place where it doesn't appear is in consolidations. That would be an impossible question. So, whoever has the risks and rewards, it is that person who must behave as if he or she is the owner. So if I transfer the asset over to you and I say, you look after it, if it breaks down, it's your problem, you keep it for as long as it lasts, aren't you behaving like the owner? Even though legally I'm the owner, using substance over form, it actually moves over to you because you have physical possession as long as the asset lasts. So even though legally I haven't been paid and therefore I'm still the owner, for all accounting purposes, it's as if it's your asset. So it goes on to your books, you depreciate it, etc. So that's the concept. With an operating lease, obviously, it's always going to be on my books. I'll depreciate it. All you do is charge your income statement with a bit of rental. So it's actually a very, very easy concept. If the examiner challenges you to explain financial and operating leases, I would suggest draw a line down the middle like my note does and put down a few bullet points. So study those couple of pages, page 118 and page 119. Towards the end of page 119, I come to that word substance over form. That's the concept. Whoever uses the asset treats it as if it owns it, irrespective of whether it has been fully paid for or not. Several IASs cover that as well. Now, what you've got to do is to use your imagination. If you have an asset, you're the lessee. If you have an asset that you're using in your business, let's say this is a motor car, you have it on your books as a financial lease, and you depreciate it, etc., it'll make not a great deal of difference to owning it outright. If, on the other hand, the same asset is not a financial lease, but let's say is an operating lease, completely on the other side of the line, so to speak, the operating lease does not record the asset in the books of the lessee. So would you agree, when you're doing ratio analysis and interpretation, the capital employed with a financial lease is much bigger than if you had an operating lease. So the operating lease will give a distorted, better return on capital employed ratio than had you had it on a financial lease. So just watch out, be ready to make points like that when you come to your question 3, which is interpretations and or cash flows. So may I invite you to study those couple of pages very, very carefully. However, at this stage, what I need to do is to take you into an examination question or two, and in particular, the one that follows, the asset on a financial lease. So would you turn to that page now, please? So we start with in arrears. So let's open a new page in our notes. I'd like to work with you on this, explain to you how the entire system works. In arrears, leasing, IAS 17, if you can remember that. In arrears implies, as you can see from the question, that the installments are paid at the end of each year. So, how do we get marks in the exam? Clearly the examiner is testing you to see whether you understand leasing. Executing the numbers is very easy. You have to understand it. So, allow me to do this, if I may, in 3 steps. Step 1, the price structure. Step 2, the movement of the liability. And step 3, what happens in the financial statements. So let's start with step 1. I'm assuming, of course, this is a financial lease. So I might say that in brackets. Financial lease. Step 1 is the price structure. You can tell from the question that the lease price is $5,000 per annum for 4 years, 4 installments, and so that's $20,000. Do you agree that that lease price must include some interest? We'll then take away from that the cash price, which is given as $14,275. Reading the question carefully. 5,725, and clearly that is my total interest. Or finance cost, if you prefer. So can I just reiterate that? What's the lease price? The total payments you, the lessee, will make to the lessor. The cash price is what's given in the question. In other words, had you bought it outright from the manufacturer, that is the amount that you would have had to have paid. Right. Sometimes the examiner will ask you to explain what is total interest, indeed what is interest. So I wonder if I can put forward 1 or 2 ideas you might be able to use. Would you agree that total interest would include things like the risk of default, the fact that I might not pay, admin costs, profit. We're dealing with a bank. I'm the bank, the lessor, you're the lessee. Time value of money. etc. All of these items are the component parts that make up total interest, and that's what the bank gets. So far, we've done step 1. We're now moving into step 2. So step 1 was a price structure. Step 2 is the movement of the liability. So let's say that. It's a summary table, i.e., movement of the liability. So we're doing the lessee's books in arrears, and it's a finance lease. What liability are we talking about? The fact that I've given you the asset, you've taken possession of it, and you haven't paid me anything as yet. So obviously, at point of delivery to you, you must incur a liability. What happens to that liability? It starts off at being the cash price. As time goes on, interest is added. Eventually, when you pay the last installment, everything is clear and the figure becomes nil. And that is a process I'm going to show you next. Summary table, movement of the liability, probably about 6 columns. So give me a chance to run ahead and lay this out. On the far left, use the entire width of your page, you have the year. Nearby, you have the opening balance. That will tend to be the capital element. Next to that, you'll have interest plus interest, and that gives you the outstanding balance. A subtotal for the outstanding balance, OS like that, outstanding balance, minus the installment to give us eventually the closing balance. So, let's commence operations. If I give you a chance to write that down, be very clear about what you're doing. You have the year, you have the opening balance, you have the interest, also known as finance cost, but at the rate of 15% according to this question. You have the subtotal. I like to do the subtotal. I would recommend that to you as well. It just helps you to hold things together at exam speed under that huge pressure you'll face. And once the installment has been removed, you have the closing balance. So, year 1. Start with the cash price, $14,275. These are all dollars, ordinary dollars. Interest on that is 2141, say. The subtotal, the running total, is 16,416. Take away 5,000 of an installment, and you have 11,416. You detect from the end of the question that that is the date at which you must report, do your income statement and your statement of financial position. However, what I'd like to do, with your permission, is to complete the process for the 4 years. Just gives you a little bit more confidence. In the exam, I would suggest doing at least 1 more year so that you have a full story with regard to current and non-current liabilities. But may I seek your permission to do all 4 years so I can explain it a little bit better. The second year sees the 11,416 coming forward. 15% thereon is 1712. The running total, 13,128. So clearly the opening plus interest equals the subtotal or outstanding balance, OS. If you take away 5,000, the running total is 8128. Comes forward, 8128. Interest thereon at 15% using a calculator, 1219. The opening balance plus the interest is the subtotal, 9347. Take away 5,000, and you come to 4347. Year 4, 4347. Fairly easy, isn't it? Calculator in hand, nice organized approach, very straightforward. Now, somewhere towards the end of these exercises, let's say the last year here, you have to tread a little bit carefully, be a little bit careful. Shall we say that over here, I ought to be showing nil. Now, I'm the accountant working for you, so this is the lessee's books. Clearly, the 5,000 must be taken away, and if I put 5,000 in there, I'll make absolutely certain there isn't an embarrassing $1 left over at the end of the exercise. You must show your understanding that, of course, when they say 15%, it isn't exactly 15%. It might have 4 decimal places. But the examiner tends to round it off, so be mature about it. Clearly, if the answer is to be nil right at the end, and you've got 2 5,000s deducted like that, the difference between the 4347 and the first 5,000 must be 653. Don't make it 652, it won't add up. So I'll say, indicating that I've slightly rounded it off. So there you are, that's the end of the exercise. If I can just take an overview with you, the total of all the interest should be 5725. Let's just check the last digit, 2 and 1, 3 and 9, 12, and 315. Seems to make sense. The total of the installments is 20,000. So I suppose, taking an overview, this figure, cash price, plus, so the cash price plus interest minus 20,000 gives you nil eventually. So the system has come to rest. I hope that makes sense. So that's the second step done. Let's move to the third step as we attempt to understand what happens in the final accounts. So here we are, step 3. Step 1, to recap, was a price structure. Step 2 was that schedule. Quite easy, even though when you look at it at the end, it looks quite demanding. It's actually quite easy. And step 3, probably the cleverest of the 3 points, is what happens in the financial statements. Income statement and statement of financial position only. Now, I'm going to explain this in a special way. I'm thinking about you getting a safe 65, 70% on this question. So if you can score the easy marks, let's keep the fancy last 30% to one side. So allow me, please, to divide my page into 2 halves, a little bit more room on the right maybe. So I'm going to work down virtually an entire A4 sheet as I attempt to explain the financial statement side of this. Clearly, our paper's called financial reporting, so what happens in the financial statements is absolutely crucial. So here we are, step 3. the income statement to start with, and then the balance sheet lower down the page, statement of financial position. Now, I wonder if I can be so bold as to describe these things as easy and not so easy. I was going to use the word difficult, but I've refrained. Easy and not so easy. Less easy. Right, what happens in the income statement? Let's pick up our easy marks, the straightforward marks. Clearly, depreciation per annum. We're just doing the first year, by the way. Can I just go back and clarify that? Year 1. So I'm only doing it for year 1, as the question says. So what is the depreciation for year 1? You pick up your cash price, which is 14,275, and you divide by the asset's life, which is here 4 years. And so that is 3,569 per annum. Keep that logic flowing. Step into, a little bit lower down the page, the statement of financial position, SFP. What can I bring in here? Clearly, the cash price must be depreciated. So in your non-current assets, we must show the cash price less depreciation. So cash price 14,275 less depreciation to date, which was a moment or two ago 3,569. That 3,569 I shall deduct to give us 10,706 net book value. One has to say that is easy. Now, I've probably got about 70% of the marks, maybe a bit more. I can relax, maybe even 80%. I've passed comfortably. But if you can manage this next point, that would be marvelous. Let's see. We'll call it less easy. We'll stick with the income statement approach. Clearly, apart from depreciation, you need to bring in the interest, also known as finance cost. That, for the first year, is 2141 from the table. Now, this is paid as part of the first 5,000. So nothing is outstanding at the year end. It's paid, charged to income statement, and that's the end of the matter. Now, alongside the statement of financial position simple point, here comes a slightly more difficult point. And only the good student will get this far, but let's see if we can keep up with them. No reason why not. Clearly, the amount that is due by the lessee to the lessor, 11,416, needs to be split. So if I can just give you that as an indication, split the 11,416 into current and non-current liabilities. So let's start with current. See what we can make of that. Can I say that, looking at the table, in the next year, at the end of that second year, you have 5,000 that's due. But in that 5,000, sits the 1712, that is the second year's interest. Would you agree at the end of the first year, whose accounts we are doing, year 1, the second year has not yet become payable. The interest only clocks up as that second year begins to happen. So at the end of the first year, the second year's interest is not yet due. The first year's interest has been cleared as part of the first 5,000. So all you have to do is to say to the examiner, the capital element only at end of year 1 or start of year 2 is 5,000 minus 1712, which is year 2's interest. So this 1712 is year 2's interest. So the answer is 3288. So the crucial point is interest doesn't become due until that time passes. So future interest must always be eliminated, must not be shown because it's not yet due. Okay, so that's my current liability. Let's face my non-current next. The non-current liability is simply the capital that's due 8128. I'll put that in a little box. I'll show you where to get that from the table. If you add that up, you have 11,416. And so what does that 8128 represent? Let me show you the examiner's method. What Steve Scott reckons, and I'm absolutely in agreement with him on this one. In fact, I agree with him on all things. But this particular one, what he says is, if you pick up this 8128, that is capital without future interest that's going to be paid in years 3 and 4. Remember, we've dealt with the current liability, which takes care of year 2. And we have to look at years 3 and 4. Why do we do this? Because traditionally in accounting, you have to split liabilities between current and non-current. Okay, you cannot just say this is a lump sum liability of 11,416. It is your duty to split that between current, the next year, and thereafter, which is non-current. So if you think about the 8128, what does it represent? First things first, if you pick up the 8128, that's your answer. But what is it? It must be the future lots of 5,000, 2 of them. So 5,000 and 5,000 minus future interest, which is, of course, 1219 and 653. Clearly, if you add 1219 and 653 and deduct that from the 2 lots of 5,000, which is 10,000, you do come back to 8128. So, if I can just conclude by saying on the last line, last paragraph, say, an absolutely crucial point, if you please go on to that last page. The not so easy area, non-current liabilities, etc. What I'd like you to say, some around here, never forget to remove future interest from the liabilities shown. Interest is a function of time, and unless that time passes, interest does not clock up. Thank you. That brings me to the end of this particular session, which deals with the differences between financial and operating leases. Do study my notes. And of course, it takes you into a past exam style question on finance leases in arrears.